Record on his computer. All right, we are recording right now. So I want to welcome everyone. Thank you so much for taking your time to attend today. I really hope it's going to be valuable for all of you. You're going to learn a lot of things and you're going to learn how to utilize all of those concepts that we have been talking up so far. And all of this is going to be recorded. You can rewatch it later as many times as you like. Take notes. So don't like really try too hard right now to remember everything and to really like go all in on note taking. But for those of you that are currently live right now, you can always interrupt me to ask questions. So after each concept or after something that I explain, I'm gonna tell you like, do you have any questions? So don't hesitate to ask in the chats. Just unmute yourself or something like this. Devet is gonna add along the way as well if he thinks of something. So we're gonna keep it pretty interactive, pretty informal again. Like it's not something like super major. We're just working right now on improving everything that we know so far, introducing some new concepts that will hopefully improve your training. All right. So the first TFGW bootcamp, let's give it a start. What are you gonna learn today? Well, yeah, in the overall bootcamp, right? So first of all, we're gonna start with a difference because many of you actually come from continuation trading 2.1, 2.0. We have 1.0 as well that many of you are currently learning. So I'm just gonna lay out right now the first thing, what is the difference between manipulation and continuation and how you can actually merge them, because I think that's been a problem that some of you found hard to address, and I'm gonna tell you what's the solution to that. Which pairs to trade and at what time? When does manipulation occur? So you're gonna see, like, we're gonna create a trading window for every single one of you, because I really don't want you guys to be trading all day, to be looking for trades from Asia all the way to New York close. It's really not worth it with this strategy. You can just sit on your screen, believe me, for 2-3 hours just to grab some London pips, and then you're done. That's it. If you want to, again, you can come back in New York to have a look. But yeah, I'm just rushing right now. We have this everything explained. Timeframes, which ones to use, right? So we're gonna have a deeper look on timeframes. And again, depending on your style and on your work, of course, you can use the strategy with as a swing trade strategy, and then you can use it as scalping as well from the other hand. So it's pretty powerful, all of those concepts. We're going to look into order mitigation, something that hasn't been explained in a lot of details. So we're going to cover this one, all the new concepts that we're going to be using, all the terminology, explain in detail, in-depth entry models and manipulation patterns. This is for the second day, where the vet is going to take us through a pretty nice journey on the manipulation entries and patterns, entry criterias, how to forecast the day and the week, because you know the market is fractal, so it repeats itself on every time frame. What you will see on the monthly time frame, the same you can see on the 1 minute and on every time frame. So all of those patterns are repeating themselves on every time frame. So once you understand how it actually moves, then you can utilize each time frame to your advantage, right? Flow chart of the strategy, this has been requested a lot. We already have it, but I'm not gonna spoil it right now because it's for next week. And then we are gonna have some trading view tips so that you can keep your charts organized and pretty neat. Let's get into it. So the main difference between the continuation and manipulation strategy. So first of all, like TFW, the first module and the second module, they are super important. They work amazingly, especially 2.0. It's my favorite. 2.1, I haven't really focused on it like pretty much these days, because like you have to scan again all the market. It works with all the minor pairs, right? So you have to scan, for example, 30 pairs, look for the push, look for the pullback. It's still fine. You can use the indicators. I've seen some guys actually implement 2.1 and manipulation. Let me see. Somebody joined, and all right, good. I muted them, right? So yeah. So first of all, if you try to combine TFW and DW, you might find it a little bit hard at the beginning because it requires a little bit too much focus, right? So imagine that you're looking for a push and a pullback. You have a full hourly high or low, but then you have an order block just below that. And you're like, okay, so what am I looking right now? Manipulation says, wait for a deeper pullback. 2.0 says, look for a long entry already. So this is when the confusion comes in, all right? So my first advice will be to focus on one thing at a time. Start from continuation training, especially if you're just starting out, right? For the new guys that joined in, study everything. Don't just go from the second to the first and then to the third, or from the third to the first. Start from the first module, introducing all the price action concepts. Go to the second, learn manipulation, because market structure is really essential. And we're going to see it a lot with DW as well. So don't think that the first continuation strategies are not going to be used anymore. And yeah, as you can see, for beginners, focus on TFW, and your main focus is to master market structure. And then for more advanced traders, we already have quite a few people that have really mastered TFW. They're trading it in a very nice way. Then it's time to transition a little bit to a more complicated approach to introduce new things, which we're going to be doing right now, right? So again, the little example that I provide, you will often be confused when, for example, we have a full hourly lower high, but an OB is just sitting a little bit above that. So I just want to give you a little example of this one. So imagine you have a push, you have a pullback right there, and this is your lower high formation. But imagine you have right there an order block that you would like to take a short from, right? So that's when you decide, do I wait for the OB to be tapped, or do I enter 2.0 from right there for a short? And this is the biggest problem so far. I've received a lot of questions on this thing. And again, as I told you already, you have to focus on one thing. And personally, you can see taking the knowledge from DW and then applying it to continuation trading works amazing, right? So I would often base 2.0 setups around hard time frame OBs. So if you go back to the previous example, if you have that full hourly lower high there, and full hourly order block, and that you are about to create a full hourly lower high, it will be much better to wait for the OB to tap, and then you're going to be provided with the actual entry, right? So you can always use OBs in confluence with the 2.0 strategy, right? And I want you to know that it is a mindset that you're learning right now. So make sure to take all the tools with you, apply them to your trading, and then the strategy doesn't really matter. Just make sure to apply what works for you, because I have seen some of you, I think first that comes to mind is Raymond. He is using 2.1 indicators, merging them with order blocks, and it works amazing, right? We have some people that use 2.0 with OBs. It works amazing as well. So it's all about you putting the work, the back testing hours, and using all of that knowledge to figure out what is your trading approach, what is your trading style. Because even if you trade the same strategy, I've said it numerous times, each one of you have different personalities. So for example, me, I'm super conservative trader. I'm going to wait for 10 confluences before taking a trade, while some of you just want to see the price push up and then take it from the sniper on the top, right? Some of you will be more aggressive, some of you more conservative. And again, there is no one suited all approach. You have to find what works for you. So again, guys, if you have any question that can be a follow-up of the difference between continuation and manipulation, how to apply them, make sure to shout. I'm going to be there to respond. But right now, taking into the next slide, which is pairs and time, right? So I told you many times, less is more. And I really want you to write this somewhere. I have it printed in a little, what was the name? In a little frame, right? Less is more or less. And yeah, the less pairs you focus on, the more probability. And let me see, somebody's joining. And the better opportunities. And most importantly, the better focus you're going to be having. Because you cannot monitor 10 pairs and be aware of every order block, of every daily direction, of every this, of every that. You just can't do it. And here are the pairs that I suggest, because you see, manipulation works great with manipulated pairs. Which are the most manipulated pairs? Well, there are the majors, right? Where the most volume is, they're heavily manipulated, especially EU, because this is the most traded currency pairs across the Forex market. And then we have Euro dollar, Aussie dollar, GU, the best one, NU as well, NZD USD, USD JPY, USD CAD, USD Swiss franc, and then we have GJ and EJ. All of them work great with manipulation and they are tested, right? Some of them work better than the others. For example, I would immediately say GU. This is this is just the pair using this. It works so good. GU works great with GJ as well, but a problem that could occur is they move more or less the same. So sometimes you're going to see exactly the same setup. And if you want to trade them both, you have to divide your risk, right? So if you want to risk 1% per trade, but if you want to take the same trade because they're positively correlated, then you have to spread it in half. So you risk 0.5% on GU and 0.5% on GJ. I don't really like UCAT and USD Swiss franc. Not sure why. USD Swiss franc has been really messy recently. UCAT is a very consolidative pair. And let me see, some guys are also joining. Marvin. UCAT is a very consolidative pair. So it kind of creates a big consolidation and it starts to run. Then it creates another consolidation. Then it runs again. So I'm not loving it too much. UJ works pretty good, but it has, again, its own personality because each pair has its own personality as well, as we as traders do. So UJ tends to move a lot during New York. So I have been stuck in UJ many times, taking a manipulation trade in London and then consolidating all through the session. And then New York decides to stop me out and then hits take profit massively. So again, if you're trading UJ, perfect for New York. AU as well, what we observed very recently is that AU works great with New York session as well. Because again, if you have a look at the pairs, at the currencies that comprise AU, it's the Australian dollar and the US dollar. So Australian dollar usually will move around Asian session, and then the US dollar around New York, right? So it doesn't make too much sense for this one to move during London, right? EU, perfect for London. GU, perfect for London. NZUSD as well, moves a lot during New York. And then the other ones, we have to test them out. EJ, I'm not entirely sure if EJ, haven't done enough testing. So this is something that you would like to do as well, right? And again, the rule is you don't want to trade more than 4 pairs. Why? Because of focus. You want to be focused with that strategy. You need to know every single time frame. You need to know what is the direction, what are the OBs, where will potentially price reach for, what is the psychology, how the market has been developed. And you cannot follow more than 4 pairs and be really concentrated. So again, guys, make sure to cut your list and pick all of your favorites. But again, testing has to be done. All right. The best and most volatile liquid trading sessions are London and New York, of course. We all know this. So here, don't pay big attention to the time right now because a little bit later, I'm having a little bit of a graph that's going to help you out. But London trades can be taken from 7 a.m. GMT. And this is basically your Frankfurt Open, right? And we're going to have a look at when the Asian session, you can see it ends at 5 a.m. GMT. Then you have like a dead hour, right? So you have the 6 a.m. GMT, which is a little bit dead. So the market is starting to set up. And then you have the Frankfurt Open. And the vet is going to explain in the next webinar and the next bootcamp that we can have multiple setups judging by the Frankfurt as well and by Asian price action, right? And then this is from 7 till 11 GMT. This is entering lunchtime. And we don't really want to be opening too many trades at that time because the market starts to slow down. It starts to consolidate a little bit. And it's potentially transitioning into New York. So New York can start as early as 12 p.m. GMT. So this is the earliest, but usually, not usually, but New York opens at 1 p.m. GMT. And it runs until 3 to 4 p.m. GMT. And this is not when New York closes. This is like the trading window. This is when the opportunities are going to happen. This is when we want to trade. Because if it gets later than 4 p.m. GMT, then the market has already filled the daily range, right? And you don't want to be taking after that time. But again, more on timing on the next slide. And as you can see, after 3 p.m. GMT, London session is coming to an end, which will usually bring some final volume. But this final volume can do 2 things. It can either, so let's say you are short. Let me grab the tool again. So let's say you took a short from right there and it's running down and it's coming into 3 p.m. GMT when usually London session is coming to an end. 2 things can happen. The market can either continue to flow strongly down or it might form the low of the day and then give you a big retracement. And then the market is going to close right there. Because as you know what the market does, it opens during Asia, consolidates, it fakes, it creates the big expansion during London and New York, and then again can consolidate or even pull back to close around the middle. So this is kind of your daily range. So again, when the market comes close to this timing right there, try to secure your cash, try to secure your trades, maybe close them or manage them aggressively. Right? And then we have the Asian session, which is from 1 to 5 a.m. GMT. So later, make sure to write this down, memorize it so that you can know how to illustrate your Asian range. Then we have 6 a.m. GMT that is usually a little bit quiet. And then we have Frankfurt Open. And then we start getting the action. All right? So this is pretty important also because we had a little question about this. What is the meaning of the 12 o'clock of the midnight New York time open? The daily range, like how the banks work, the daily range is mostly filled from 5 a.m. GMT. And this is your Asia close. So when Asia closes, you have like this consolidation, and then you can expect the market to start moving, right? And it will move until 8 p.m. GMT. So this is your daily range. This is your daily, where is that to again? This is your daily trading window, all right? So you don't want to trade before 5 a.m. and you don't want to trade after 8 p.m. GMT, right? And this is when this little New York time open originates from. This is the Asia close, and this is basically when you expect the moves to start happening. So you're often going to see on our charts that we have, for example, the market open like this. If I just, let me try, let me see. I bet you're actually seeing my screen right now, the charts. So if I just remove this, all right? So what you want to do every single morning is you go to your charts, right? And you find that time. So if I want to go to New York right now, this is, where are you, New York? Okay, I know what it is my time. It's 6 a.m. So I'm going to find 6 a.m. Here it is. This is 6 a.m. So I'm going to take my arrow and I'm going to mark it on that candle open, and I'm going to drag it like this. Then what I'm going to do is, this is my daily open, right? And this is where the market opens. And again, as you can see, here is your Asian consolidation. And after this point, the market will paint the day, right? The market will show you what it wants to do for the day. And here you have that big expansion, right? And if we have another example, let's try the previous day. So again, you go, where is your 6 o'clock? Should be somewhere around there. Here is your 6. So what you do, this is the candle. This is actually the 6 a.m. candle. You drop it like this. I have it as daily open. And then what you expect, usually the vet is going to explain that in the next bootcamp, is you can actually, if you're looking for shorts, you would expect the market to run above and then to go down. But as you can see, the market consolidated. This is your open. And after the open, you expect the move. So here is the move. And this happens every single day. Therefore, it's super important to take notes of this midnight New York time. All right. So enough of this. Again, guys, if there are any questions, make sure to shout, type them in the chat. I'm always going to respond. And yeah, so right now we are going to determine your trading window. You don't want to trade from Frankfurt open to New York close. You really don't want to do that because it's not productive. It's not nice. And it's not how it's done. Right. So here are the trading windows. Little notes. The time is indicated in GMT. Right. So make sure to have a look at this graph. So again, as you can see, we start with the Asian range, which is from 1 till 5 GMT. This is when we have that consolidation. And then we have the 6. Okay, so this is the pre-London. This is chart prep. This is the dead hour that I spoke about. So this is when you have to wake up and do your charts because the market will usually be slow and it's cooking for Frankfurt Open, which is basically, no, it's not. The Frankfurt Open is 8 o'clock my time. So this is when we actually mark that's the New York Open, right? The 0000 time. Then we have the London window. This is the time that you want to trade during London. So you have first the Frankfurt Open, that is starting from 7 GMT. Then you have London Open, which is the best, that starts at 8 GMT. So this is your timing window right there to be looking for trades. GU, EU, all of those pairs are gonna be reacting and trading during that time. And then I would really recommend that you stop looking for trades and really like being active in the market around lunchtime, which is 11 a.m. GMT, right? Because it is said that the institutions are going on that, like not the institutions, but the bankers or whoever traders are, they're going on the lunch, like the market is slowing down a little bit. And this is your transition into New York. So what we have right there is 12 o'clock, which is pre-New York timing, where you have to chart prep again. You see, we have pre-London chart prep and you have pre-New York chart prep. So if you want to trade both times, you have to be preparing your charts at those specific times, right? I'm just having some questions. This 6 pre-London chart prep is our, exactly, yes. The Netherlands is +1 GMT. So whatever you see the timing is +1 for us, right? And then we have New York trading window, right? It starts from 1 and runs up until 16. And this is your actually London close, right? It's not New York close, it's London close, and you want to stop trading. You see, we already have the red light. And then at 5, if you're still in your PC, you want to journal, manage positions, cut trading, and just chill. No trades afterwards. And I have seen, especially Jack, he has been taking some trades around Asia, like which is way out of that window. It's around right there. You don't want to be taking trades at that time because it's low probability. And again, I've been listening a lot and reading a lot of books as well. People, not only traders, but people cannot be focused for more than, let's say, 2 hours. So you have to determine for yourself when you can be completely dedicated on trading for at least, like, let's say 2 to 3 hours. Because let's say you have your London window, that is 7 to 11. This is 4 hours. And then you wait a little bit and then you trade New York. And this is another, what is it? Another 3 hours. So you are not going to be focused at all of that time. Therefore, try to figure out your trading window and when are you gonna trading. All right, super important. So again, guys, if you have any questions, I'm always open. David, do you have something to add so far, bro?
No, all good so far.
Let's see what we have next. All right, time frames. So this is pretty important as well. So let's see what do we have. So how do we do top-down analysis? Super, super, super important. And again, as I said in the beginning, in the introduction, the time frames you're going to utilize are mainly going to depend on your lifestyle and character, what kind of work you have, and what is your character as well? Like, do you want to scalp really the 1 minute, or are you more like a swing trader, being more used to the hard time frames? It doesn't matter because everything works, right? As you can see, all concepts that you will learn apply to every time frame. So if you learn how to spot those formations, then you're all good because you're going to see them on every time frame. So the first time frame, we're going to be using 3 time frames, all right? The 3-step approach. The first time frame is our directional higher time frame, all right? This is when we identify the higher time frame direction, like where is the market going over the long term, right? Then we have the middle time frame, where we can look for refinements and structure. So the middle time frame is where you're all going to get confused, all right? And we're going to provide you with a lot of chart examples during our daily analysis, charting sessions as well, webinars, right? Let me see, misclick. No problem, bro. And because right here on the middle time frame, again, if I just illustrate, let me just illustrate something. So let's say that you have your directional time frame, you have a push to the downsides, all right? So this is your lower low. The middle time frame can show a nice downtrend as well, and then you're going to start having that pullback, all right? So the middle time frame will turn bullish, but you have your OB, you have your higher time frame OB sitting exactly right there. And then using your middle time frame, what you can do is you can counter trend. This is why we're going to use the middle time frame. But again, I always suggest if you're not used to this one, just mark your lower low and just wait for the market to correct towards your area and then take a high probability short, right? No need to trade the counter trend. But this is the main usage of the middle time frame. And of course, to refine the directional higher time frame, because sometimes you're going to have like a big OB or something that is not entirely clear. The lower time frames are always going to give you a more precise entry point. And I'm going to show you a little bit later how to do that, right? And then one time frame lower is where we start diving deeper once the price gets into your strike area. All right, finally, this is your entry time frame. This is where you wait for an entry. So after the market has tapped into a directional higher time frame OB, you have refined it to a middle time frame OB as well. So you know, like an area of precision. It taps into that area, then we drop to the entry time frame, which is usually 15 minute, 5 minute, 3 minute, 1 minute, and 5 minutes as well, right? And as you can see right there, I created a little bit of a, kind of a separation. So you can see we have intra-week trading, which I would say is more like a swing trading approach, right? Not really swing trading, but something in the middle. So we start from the daily time frame as our directional time frame. This is going to take a lot of time. I want you to know this, because if you have a daily high, it's going to take a long time for the market to pull back, to tap into a higher low, potentially strike area for a higher low, and then to potentially move. But then what you can do is you utilize the middle time frames to potentially go counter trend, but you always consider the daily as your hard time frame, right? And then you usually won't go lower than the 50 minutes to enter a trade. For intraday trading, what I usually do, what I love doing, is you start from the 4-hourly time frame, right? You determine your direction there. So you don't look too much on the daily. It's always good to keep a little eye there, but you start from the 4-hourly. Then you refine on the hourly time frame, right? This is what I do every single morning in the daily analysis. Then we jump on the 15 minutes to have a look for further refinements, like what is the Asian session doing? What is the Asian range? What are the 15-minute OBs? And then once the market taps into those areas, right there from the hourly and 15-minute. I drop to the 5-minute and I look for an entry. And then we have a scalping approach, which also works. You can use the hourly time frame as your hard time frame, right? So see how we're starting to drop really down towards scalping. 15-minute will be your middle time frame. 5-minute could be further refinements, and then we enter in the 3 and the 1 minutes. How long would you say intraday's trade should last? Well, yeah, an intraday, yeah, it really depends on average. Like sometimes it depends on the volume as well. Like sometimes your take profit can hit in 30 minutes. Sometimes it's going to take 3 hours. Sometimes it's going to take 4. Sometimes it's going to take 6. It's not really fixed, right? But we as day traders, I would like, yeah, if I really think of it, I haven't held a position overnight for months. Really.
I think at most it will take either just the London session or the London and New York session to bring that trade to fruition.
Yeah, I agree. Because you remember from earlier the New York open time and then the London close. So this is it. Like whatever happens during that time, that's it. And if you want to hold it, no problem. But usually your area of interest should be hit around that time, right? Because we are mainly focused on intraday trading. We're not doing swing. We're not holding over the week, which we could do, but we're mainly going to be utilizing 5-minute, 3-minute, and 15 minutes for entries, which is bringing us a very tight stop loss, which means that our take profit will be hit very quickly. All right. So thanks, Jack, for the question. And yeah, so super important point is to know where the price is according to the hard time frame, of course. A lot of confusion can occur with the major and minor structure. As I said, the major usually will be the 4-hourly, and then the minor would be the hourly, potentially pulling back. Always have your hard time frame areas of interest, and you can counter trade until they are tapped. Right? Show example. I'm going to show you a little example on the chart as well. And then I'm going to jump to the charts to explain something pretty nice as well. The concept of premium, which is a high price, and then discount, which is a low price, and how we can use this one as well. So let me jump to the charts very quickly. So first of all, what I usually do as well, so let's say the daily, let me just go to a clear chart maybe, somewhere right here. So let's say we start from the daily time frame, right? So what is the direction? Like if you really want to zoom in, like I'm not going to look for the swing points, because even if you drop to the weekly time frame, this is our low and this is our high. So right now, if I'm to illustrate actually the concept of premium and discount, what I do, drop it from the low of the leg to the high. And this is how I have it. I'm going to open the settings so you can copy what I have. The 0 is this color. The 1 is this. And then I have this as that. And then, yeah, the background, you can make it like this even, -2 Carrefour. So yeah, this is what I have, right? So as long as the price stays above the 50%, so this is just a simple 50% fib, right? So as long as the market stays above, this is a low probability buy. Why? Because institutions will be looking to drive the price lower in order to get a better price, right? To buy at a discount in order to later rush into the highs, right? So currently, in terms of a weekly time frame, again, what you can do also, what I do is drop the horizontal ray, plot it right there, drop another one, plot it right here. And then again, what you can do is you can do, yeah, you can see I have full hourly low, but I'm just going to do like this. So we do, come on, man. This is our weekly low, and then respectively, the other one is our weekly high. And then once you drop to the daily time frame, it makes a little bit more sense, right? We're going to remove this one, but you know that this right here is your weekly range. Right now, we zoom in on the daily, right? We don't care too much on the weekly. On the weekly time frame, though, I'm going to be looking for this OB right there. And we're not getting into OBs right now, but let's just keep this in mind. Then dropping, oh man, disappeared. Okay. Then dropping to the daily, again, we zoom in and again, we follow market structure. I really want you to focus on that because market structure is crucial. What has this market done so far? It was pushing in an uptrend, higher high, higher low, creation of a higher high. Where is your last higher low? It's right there. How do I identify this one? Well, it's a clear pullback. And if you struggle with this one as well, you can drop to the line chart. Just leave those drawing. Drop to the line chart, and wherever you see line formation, like, yeah, let's say this V-shaped formation, or the other one like this sharp formation, this is where you have a higher low, right? So this one was actually broken right there, retested, and another one was created. So this starts building our daily range. But if I just focus on right now, how I'm gonna utilize the market, where is your last break of structure, right? So we have this push to the downside that breaks this structure right there on the left. Because this is our last lower low, we created a lower high. We strongly pushed to the downside, broke that structure. So where is our lower high right now? It's right there. It starts from right there. So what you do, you take your horizontal ray, plot it right there, take the other one, plot it right here, and this is your range. If you want to sell this market, what you do, you grab the fib. Do you want to sell it right there? Not really, because more of the times, the market will come above the 50% to fill that little bit of imbalance right there. We're going to speak about imbalance in a bit, and then it's finally going to start flushing, right? So this is how you want to mark your hard time frame areas. And then again, if you drop even to the forward time frame, how I'm going to be looking at this right now is you can see, all right, where is my last lower high? It's right there. Did it get broken? Yes, it did, right? Because if I take, you can see we have a candle close above. So what I'm going to be looking for right now is for the market to pull back, potentially to create a low, a higher low, and then to potentially start pumping up towards this daily high and towards the premium price of the daily range. And where is the premium price of the daily range? Remember, it's above right there. So I'm going to be looking to sell into this quadrant right there, right? And yeah, this is basically it. Then once we drop to the hourly time frame, we want to drop to the hourly time frame once we have our full hourly bias, right? So if we're looking for longs, then what I'm going to do on the hourly is I'm going to drop to the hourly and I'm going to search for potential areas, all right? So right there, we have the market consolidating, took out liquidity, broke structure, first break of structure right there. First retest and a huge explosion. So the real move starts from right there. So if I'm looking for another buy, then I'm going to say, this is my OB right there, and I'm going to be looking for a buy from here. But then if I drop to the 4-hourly time frame, the OB is going to be right there, right? This bearish candle. So again, this is how you build the confluences, and we're going to speak about that just in a little bit. So let me see what I wanted to show. Yeah. So basically major and minor structure. Your major structure in this situation will be, if we focus on the 4-hourly, it will be from the low to the high. And then if you drop to the hourly time frame, until the market reaches this area, it can create multiple short opportunities. Do I advise for you to trade this? No, I don't, because you're going to have push, pullback, push, pullback, push into that area. Then you're going to have a little bit of accumulation, and then the market is going to go, right? So right there, you can potentially look for shorts. And even if, for example, let's say the 4-hourly move was really big, like, yeah, let's say like a big move. Yeah, I can't really find a big move, but let's say this one right there. So we have this big move right there, right? It's creating a lower low. So where is the lower high? It's right there, because this is where the move started, right? Where is our low? It's right here. If we drop, so where are we looking for sales? Remember, take the fib. We're looking for sales above the 50% where the market is currently at. But if we see that the low was formed, I want you to have a look on the hourly time frame. So right there, nothing was clear. We faked above. We tried to break structure. We failed. But here is the moment that the market broke the structure right there. So what you can do is you can use the hourly time frame to take longs. Right? On this situation, I believe I was looking for that. I was looking for this OB to get tapped. It missed it. It pushed higher. Then I was looking for these OBs to get tapped. It didn't tap, pushed higher. Then what I can do is I can look for this one. But you can see that we're already getting into the area that we want to sell. So as long as we cross above the 50%, we no longer want to be looking for buys, right? We start looking for sales, because you can see the market is going to reverse eventually. So is that concept clear, guys? So again, you have to decide on your hard time frame. My suggestion will be to use the 4-hourly always, but always be aware of the daily as well. And then the hourly time frame, you use it just for refinements. So let me see, Jack. So if 4 hours is where major are high and are low, or yeah, are marked, this time frame is used to get the direction, still mark out the recent daily levels. Yes, you can always mark the daily levels. Yes. And most of the times the daily levels are going to be corresponding to the 4-hourly as well. Like, because if you have a look right now, yeah, not always, because right now we have this big push. So this is your daily high. So the 4-hourly price action is completely different. Like on the 4-hourly, we're looking for longs right now, but we're basing this, but we know what the daily can potentially do, so that we are not too we don't get carried away on taking longs, right? Why? I really hope you get this, and I'm explaining it well, because on the daily time frame, we just have a break of structure and a potential pullback for a short. The market is still short biased, right? So as soon as the market gets into this OB, we should be securing our trades and not taking further longs. Why? Because we can definitely have a reaction to the downside. But on the 4-hourly, the market still has a lot of pips to be reaching for that area. Let's say we have 100 pips, but if the market pulls back to the downside, we have 200 pips. So can you capitalize on the long right there into the daily level? Absolutely yes. So is that clear, guys? Like how we switch between the time frames and how you are aware of what is happening across all time frames. Did I explain it good? I really hope I did. Any feedback, guys? Any questions? Okay, Alex says yes. Joseph says yes. Bastian as well. Okay, very nice. So I really hope it's clear. And of course, we're going to do this like every single day with a daily analysis and all of that. So you're going to just look every single day at those concepts. All right. Let's have a look at what we have next. I think we're getting into the good stuff right now, order blocks. All right, the concepts. So the concepts that we're going to implement are, again, order blocks. You have already learned about them, but right now I'm going to show you a little bit more on how to make them a little bit more precise, because sometimes an OB can be a little bit too big. It can be kind of invalid. Maybe it can have a lot of differences. So I'm going to try to really tell you how to really eliminate all the wrong OBs. We have imbalance and empty space, which we mark as IMB. This is OB, IMB. The concept of liquidity, so this is LQ. Most of the times we're looking for equal highs and equal lows, which is basically a double top and a double bottom or just consolidation. And then we're going to speak about liquidity grabs, right? So let's see what we have. Nacho is leaving us. Bye, bro. Thank you for being so far with us. You're going to rewatch the recording later. So, all right, this is going to be a long explanation. I really hope I don't get lost. All right, so guys, bear with me. But I want you to imagine what it is. Why do those order blocks work, and what exactly is an order block, and why is it an order block, and what do the banks actually do with those things, right? So what is the psychology of an order block? So you can see, in order for the banks to place their orders and make money in the market, they need liquidity. And so what is liquidity? I have it defined a little bit later. This is basically to sell or buy an asset on demand. All right. And I have a little quiz later for you as well. So bear with me. So if they want to buy one lot, all right, somebody has to sell them one lot. So I really hope all of you actually know of this concept, because this is how it works. When you buy a position, there is always somebody else that is selling. So when you win a position, there will always be somebody else who is losing a position, right? Because there is a constant exchange of orders. And this is why the Forex market is the most liquid market, because it is the most traded one, right? So you're always going to get somebody that's going to sell you, for example, that one lot or buy your lot. However, what if they want to sell or buy 1 million lots? That's a different story, right? We as retail traders, like we can't go above 100 lots, I think. And I don't think like a lot of people are doing that. Possibly, yes. But let's say we're just normal guys trading one lot. But then here comes the banks that do 1 million lots. So in order to do those lots, in order to take those lots, somebody has to give them 1 million lots from the other side, right? So if they're looking to sell 1 million lots, somebody has to buy those 1 million lots. And retail traders can't do this, all right? So as you can see, yeah, our lot sizes are too low to worry about liquidity. So we're always going to get executed, right? But imagine you have those lots and you know that you can't just go to the market right now and hit buy. You're not going to get executed. So what do you want to do in order to get your orders executed? And this is when the concept of liquidity in order blocks comes in, right? So imagine we want to take those 1 million lots. We can't just execute it and just place our order on MT4, right? So let's have a little bit of an example, a little bit of a case study. So let's say the bank wants to place 1 million lots to buy euro dollar, right? So at the same time, they will need 1 million lots to sell euro dollar so that their order can get triggered, because else, I don't know what's going to happen. It's just impossible to do this. There's going to be either a huge gap, and I think it's actually illegal to do those stuff. I'm not completely aware, but they just need the opposite lot sizes, right? So that their order can get liquidated or just confirmed. Now, the question is how they can make people sell, how they can make 1 million lots sell orders, right? Then the banks will start generating all the formations we perfectly know, all right? So this is the double tops, the flag formations, trend lines, triangles, patterns, all of that stuff, because they know how we trade. They know how retail traders trade, right? They know those formations and they know where we hide our stop losses. Not that they know where our order exactly is, but they just can presume where there are those pools of liquidity, right? We are going to focus on equal highs and equal lows, right? So let's say the banks print a nice equal low. This is a double bottom where a lot of traders are going long and their stop losses are just below. So people put trades on, which serve as fuel for the banks. And again, I remember this week, there were a lot of consolidations and some of you got stopped out in that consolidation, all right? And this is what the banks want you to do. They create confusion in order for people to take orders and then they immediately get liquidated. They get stopped out so that they can actually launch their orders, right? So hope everything is clear so far. The banks want to buy 1 million. They need 1 million sell orders in order to buy. So what they do is they have to think of a way to get those 1 million sell orders, right? So what the banks do, all right? They're gonna sell 1,200,000 lots to cause the market to drop and fake below that equal lows, right? So I just want to illustrate that so that you know what I'm talking about. So let's say that we have that push to the upside and we have the market pulling back and we're having this consolidation right there, right? So the banks wants to buy 1 million lots, but they can't buy just right here in the middle. And they have created this double bottom formation. And they know that right there are stop losses just right here, right? So they're going to sell 1,200,000 lots to cause the market to drop and fake below those equal lows, all right? So what's going to happen is the market is going to move very sharply to the downside, all right? And it's going to take out all of those orders. What are those orders going to become? They become buy orders. Because if you have a sell orders. So if all the people are buying from here, their stop loss is actually a sell order. So I hope that you're actually aware of this, right? When you buy and you place your stop loss below price, if your stop loss gets hit, your position turns into a sell because you basically sell your buy, right? And all stop losses are taken out and they hopefully equal to 1 million lots, right? So if there are 1 million lots sitting in right here, the market is going to move. But guess what? Not always there are going to be 1 million lots right there. And we actually had a question on one of the webinars. I think it was Fitki who asked, or somebody else, how do we know that the banks generated the liquidity? We don't know, right? We know that when the market actually creates the high, right? But sometimes there are not that many orders to fulfill their move. So they're going to create another formation, fake again, and then go as well, right? So let's see, what do we have? What do the banks need? Exactly 1 million sale orders. All stop losses are taken out. They hopefully equal to 1 million lots. When a buy order gets stopped out, it turns into a sell order. I already explained that. And exactly. Then they place their big order, all right? And the price skyrockets. However, what about those million lots right there that they sold? Remember? Those ones right there. Those are like the creation of the fake move. And basically, this is lots that they're staying in drawdown. So this is something important that I want you to understand. In order to sell this market, they are actually going into drawdown. And when they place their buy right there to create that order block, their sell position from right there is in drawdown. Why? Because they cannot close it. Again, why? Because of liquidity. They cannot sell right there 1,200,000 right there and then close it and buy it again. It's impossible. So what it's going to do, again, this is when the retest of the order block comes in play. Why? Because again, once the market has created this OB, once all the liquidity is taken out, what the banks are going to do, they're going to price the market lower. Why are they going to price it right there? All right, little question. Because this is where they're going to exit at break even. They're going to have new liquidity right there generated. This is when they went on a drawdown. So they're going to try to get out of their position at break even and launch even more positions to go to the upside. Right? So this is how this OB was created. It's basically a fake move. It's a big sell before a big buy, and that big sell will later get tapped again, which means that the market is mitigated again, and then we can continue up. And during that mitigation, the banks are still selling. There could be another order block created right there. So that is the little example that I wanted to illustrate, and really hoping that it made a little bit sense of how actually those things work, right? Why do we have order blocks? Why do we have the fake outs? It's because of this, because the banks need further orders in order to place their orders, right? So again, guys, Let me know if you have any questions. David, do you have something to add, bro? It's a big example, so I hope it was clear.
I think it will make more sense when we look at the charts and see it visually.
So I definitely think so.
I think we'll have more questions then as well.
Okay, good. Let's go further then. Let's see what we have. Yeah, so I actually explained all of this already. As those 1.2 million loss that were drawdown loss, the bank will keep generating formations before coming back for that OB retest. All right. This is when we have the structure break and retest setup. This is how it stems for. Because once the market fakes the move and creates the break, let me illustrate again. When you have the double bottom, when the market creates the break and creates the break of structure right there, this is an OB. And this is your break of structure. And then you have the retest of the order block, which is your best setup. All right. And this is where it stems from. The market being in a drawdown and coming back to liquidate that drawdown. And because they have to make money, right? They don't want to lose. Banks always tends to generate liquidity patterns around previous OBs as well. This is done in order to even gather more liquidity, right? So what I mean by this is, so for example, yeah, this is going to be explained again, but let's say you have, I'm actually going to explain this on the chart. Why do I do this right now? So let's say you have an OB right there that you want to take a trade from. The market can strongly impulse to the upside. And what the banks will do is they will do this sort of stuff right there just before tapping into the OB. Why do they do this? In order to trick people into buying again. What stays right below right there? Liquidity. So they're going to create another fake move, tap into this OB, take out the drawdown from their previous position, launch new orders, but they again can have a new drawdown right there. So they have a new order block. And then the market will keep doing this until they actually run out of orders, right? So I really hope that's clear. And yeah, a little mindset of that going forward. What are the patterns that I'm seeing? Let's say those are equal lows or double bottoms. What does that mean for retail traders? That means that they are probably buying at the double bottom with stop loss below the low. What does that mean for the bank? They want to sell the market to stop them out, to create an order block, and then to go, right? So keep that in mind. When you see those liquidity formations, I'm going to speak about liquidity in a little bit. This is what they're doing. And this is basically what an order block looks like. I'm having some questions already in the chat. Let me just pay some attention. Okay, Rakip is going to work. Can we forecast the stop loss and the take profit of the banks? No, bro. We can't, because they don't operate like us. They're not like, okay, I'm gonna buy from here and place my stop loss there. They don't have stop losses because they own all the money, right? So they have a drawdown, but they're never gonna close that drawdown at loss. They're gonna bring the market down again. They're gonna exit at break even, and then they're gonna launch again. And that's the process they keep doing, right? I just sometimes on live trading get confused on lower time frame to where the rest OB should be to enter the trades. To where the rest OB. Yeah, okay, let's just go to the examples. I'm gonna try to explain everything. So how does an order block look like? How to draw and refine them? I'm just gonna jump on the charts right now. The concept of order block mitigation, right? I told you and I explained why the order blocks are mitigated. What is mitigation? Basically the retest of an order block. This is when the banks are closing their position at break even, let's say, and enter new ones, right? So let's jump on trading view. Basically, an order block is the last sell before a big buy and the last buy before a big sell, right? So let's just jump on the market to show you how do we draw the OBs. Let's just drop to the 4-hourly time frame. So what I do, little trick, if you hold control, this triggers this tool right there. So basically everything gets slapped, right? You can see how my mouse is like moving like everywhere. You can see, although I'm not pointing at it. So what you do is you go to this candle, for example, you click and then again, click on the bottom of this candle and you have this. So what you have to do later is just drag it like that and have like the OB as precise as possible using the control key, right? Then how do we refine the order block? Because I said it is the last buy before a big sell, all right? But right there, what I love using is actually an engulfing candle that engulfs the order block. Why is this nice? Because it gives you a little bit more precise entry, all right? So imagine this big buy before the sell. So how will your order block look like? It will be like this. And that's a little bit too big. But then you can see you have those candles in between right there. So what I do is you just move on to the next candle and then you look for the candle that actually engulfs the previous one. So what you do, let's drop it right there. Again, using the control. Is this candle engulfed? Yes, it is. You want to see the next candle engulfed with a body the previous candle. And so it doesn't matter that our OB is this bullish candle. We can use that one, right? So another example right there. Where is our last buy before the sell? Let's say it's this one right there. Is this candle engulfed? No, it's not. We don't have a clear close. Can we take this one? No, we can't, because the next one is not engulfing it. Can we take this one? Yes, we can, because then we have a big engulfing candle. And then instead of having an OB like this, for example, you have it much tighter and much precise, which is like this. And then also we're gonna like teach you how to do those. I think the video is gonna cover this. We have 4 hour, 15 minutes, then you just click. It tells you that this is a 4H OB, and then you have it marked, right? And yeah, just maybe one more example. You can see right there, the last buy before the sell. Is this buy engulfed? Yes, it is. So on this occasion, we take this candle, control again, and then we drag it onto the left. And as you can see, tap, reverse. Again, maybe an example right there, because sometimes it could be tricky. Let's say, all right, on this occasion, where is your last sell before the buy? It's this one. So do you want to have a zone like this? Well, probably, yeah, you don't, because it's way too big. And if you drop to the hourly time frame, it's going to be way too huge, right? Have a look how much price action you have right there. But then again, let me just remove everything. Where are you? Let me do this like that, right? So what you do later is you look for the next candle. So here is your next candle, right? But is this candle engulfed by the next one again? No, it's not, right? This candle does not close above this rectangle. Then what we can do is we can take the next one, again, using the control. Is this candle engulfed by the next one? No, it's not. And then we take this one. Is this candle engulfed? Yes, it is. Have a look at that big push to the upside that engulfs the previous candle. So this right now turns into our 4 hourly order block, all right? And then even if you go to the hourly time frame, if you're looking for longs right there, you can go to the hourly time frame. Same story. Where is your last buy, your last sell before the big buy? You can take this one right there. But again, is this candle engulfed? No, it's not. Then you can take this one, which was actually engulfed. But then if we want to search for an OB inside the 4 hourly, you can see what happens right here in this little rectangle right there. This is our 4 hourly OB. You have a sell, it's not engulfed. Sell, it's not engulfed. Little candle, not engulfed. Then we have this one. And this candle was engulfed massively. So you drop your hourly OB right there. And as you can see, have a look at the precision. I tap into this one. And even if I jump on the 15 minutes, have a look right there. You have the last sell before the big buy. Is this sell engulfed? Well, I would say it is, because again, if you drop your rectangle like this, you can see that the body actually closed above. So you can mark this as your 15-minute OB. And this is how you get a big chunk of OBs that will really increase your accuracy. As you can see, this one was targeting the 15-minute OB with a beautiful manipulation, and then we ran out, right? So I hope that is clear. This is the little trick that you can use to have your OBs a little bit better, right? So again, last buy right there. Can we take this candle? Absolutely yes. Is this candle engulfed? No, it's not. Let's take the next one. Is the next one engulfed? Yes, it is. So this right now turns into our 4 hourly OB. And then we're potentially going to target this one, right? Let me check the chats. How many times an OB can be touched before we should stop taking it into consideration? Very good question. So personally, I think an OB is actually fully taken out when it taps into 50% into this OB. So as you can see, this was a perfect example. I usually want to see an OB tapped like maximum twice. Because if you have a tap, it goes. If you have another tap, then this is, if the market did not gather enough liquidity, it's going to come for another tap to potentially take out more orders that were in drawdown for the institutions. And then if they don't launch it, then I'm going to stop looking for it. So usually I would really love to see an immediate reaction around an OB. So if it doesn't move from the first time, okay, second time. But then if it doesn't move for the second time, I'm going to remove it because it's probably not a good one. So Johnny, you indicate this one. Very good one. Yes. Where is your last buy before the big sell? Well, here it is, right? Do you want to have a zone like this? Probably not. What you do is you take the next candle. Is the next candle engulfed right here? It's not. It's not really. What we do, we take the next candle. Is this candle engulfed? Yes, it is. You can see the body close below. What we have, perfect fulfillment right there of the OB. If you go to the hourly, let me just remove your circle. Boom. If you go to the hourly, what we can do, same story. Where is the last buy before the big sell? Well, here is actually this buy, we have a break right there. It's not really engulfed. Then we have this consolidation. We have another buy, not engulfed, not engulfed. This candle was engulfed right there, this one. But again, I think David is going to jump forward right there. You have to wait for the order blocks to make sense. So again, you can see right here, I tried to force it a little bit because you can see it's not clear. You want to sit and you want it to make sense immediately. If there is strong momentum coming outside of the OB, because right here you can see there is no momentum, right? You have this big wick. There is not really a sharp move. But on the hourly, we have a sharp move, right? So in this situation, I'm going to just keep the hourly order block. What you can do is you can go to the 50-minute potentially, and then you can look right there. But as you can see, the price action is pretty consolidative, right? And then you can have this, you can have that, and then you're going to overanalyze order blocks. And this is not something that you want to do, right? Let me check the chat again. What do we do when the price breaks through an OB at the hard time frame? Do we wait for a retest or just wait for the price to encounter? Yes. So if the market breaks, just smashes through an OB, then you readjust your analysis. So for example, let's say let's say this was your OB, and for some reason you was looking for shorts right there, and it just got broken, retested, and then we get broken again. So if an OB actually gets broken, then it means that the market is potentially going to reverse. So then you have to readjust again, and you'll be like, okay, that is a break of structure actually. So maybe I'm gonna start looking for longs. Where can I look for longs? I'm gonna search for my last sell before the big buy on this occasion, which is right there. The last sell before the buy. Is this sell engulfed? No, it's not. Is this engulfed? No, it's not. Is this engulfed? Yes, it is. So in this occasion, we have to use that big candle. And as you can see, Clement, tap right there, reacted. Came back to tap again, reacted, but then on the third time, we smashed. So I wouldn't have looked at this OB again, right? So yes, I hope that answers your question, Fitki. Would you want to enter as soon as it has touched, or you look for entries after touch? Yeah, Stefan, this is for the other webinar, right? So we're not going to go into entries right now, but yes, you would like to look for the lower time frames. Yes. This is difference between aggressive and conservative entry. Conservative is break of structure on lower time frame. Yes, Walter, but yes, we're just right now covering the OBs, how they are tapped. We're not just saying that we're going to take an entry from there, right?
Yes, I think Walter just answered Stefan.
Ah, okay. Oh, good. Very nice. Thank you, Walter. Yes, thank you. What would you do when price rejects an OB without a clear entry? Like this EU example, would you wait for it to come back to retest the OB? Yes. So sometimes it's just going to tap and go, because sometimes an OB is really strong. Sometimes you're just going to tap and just disappear, right? If that's the case, no problem. You don't rush it.
And that is where aggressive and conservative entries also come in. A lot of the time, if you decide on you take mostly aggressive entries, you will often get that sniper entry and you will get that first entry, but then price will stall a bit, slow down. You won't immediately see that reaction, and then it will go in your direction, or it will stop you out for another liquidity grab.
Yes.
And then go in your direction, or you'll catch trades like this example where price taps into it and then immediately changes to the other direction. And that is something just to note with EU. We get that often where it just taps and goes. Not always we get a nice structure shift in price, changing direction and showing intent in the opposite direction. Whereas with GU, it happens more often where we get GU and AU, where we get that nice change in direction, slow down, and then confirmation entries.
Exactly. Yeah, have a look, guys. Again, a very good example of what I explained with the order block theory. Before tapping into an order block, what do the banks want to do? They want to force us into taking longs. So this basically turns into liquidity. Here is your double bottom. What do we do? Boom. And this was actually the creation of an order block. This big sell before they actually plotted their positions. So what you can actually do on the lower time frames is you can monitor as well, right? So let's say the market broke structure, and then you can still apply all of those concepts on the lower time frame, but we're going to go into in depth in the next volume and the next bootcamp, I should say, right? But yeah, I just want to show you potentially if we have an entry on that one. So if you look on the 15-minute, you would like to see a break of structure. I'm going to use the 5-minute. So your structure is actually right there, which is not yet broken, right? So this is what I want to see in order to enter. Let's see if it actually breaks. Yeah, I almost broke. So what you can do if you want to look for a buy, you have this right there. So here's your last sell before the big buy. right? So is this the candle that you want to take? Probably not, right? Okay, what am I drawing right now? This candle. So I hope by now you actually know how to do it. Go to the next one. And although it's bullish, that's not a problem. Is this candle engulfed? Yes, it is. So this could be a potential place that you can just plot your order. You can put a buy order right there, stop loss below the structure, and then you can go up. But most of the times, again, you're going to see with different formations, the market is not going to come to retest that extreme. And where it might come in is right there, somewhere in the middle. This is your last sell before the buy. Did it get engulfed? Nope. So this is the candle that actually got engulfed. So potentially we can expect a tap of that area and maybe then go. So let's see. Come on, man. That is probably Asia. Is it? Yeah, it's Asia. But yeah, as you can see, again, it worked out with this middle one, right? It didn't come to the extreme because it was really clear that a lot of orders were pushing right there. And most of the times it won't make sense for them to push price that low again. And then just the concept of mitigation. Then you start seeking for new OBs that are going to get mitigated for the exact same reason. They need more orders. And then again, you can see we break structure. Where is our new order block? Let's try to find it. Right there, potentially, you can see the last sell. Then we take the next candle. This is the OB. It actually didn't get tapped, which is fine. And then we actually have the big move. So you can see on this trade, even though if we don't enter at the bottom, you can always find an entry in between. David, you want to add something, bro? You muted.
Yes, this is where the DW strategy also falls into place. If you can just keep it on here. I'm just going to get my annotate tool. Okay, but basically, we can see that price, before it tapped into that order block, gave us that liquidity.
Are you drawing,
generated.
bro? Because I don't see.
Almost. You can see the equal lows being generated there. So, as you remember with the DW strategy, where we're looking for that Asian session moving towards the side, nice consolidation, nice tight moving range. This is where the liquidity is being generated, and then we look for the OB just below it. And then often, then that is where that pattern came from, where we have this and that, where we have the sideways moving market, price pushes into that order block, and then pushes towards the upside. Now, you can get that same pattern at a different time, not necessarily at London Open, but after the big push, after the manipulation happened into the order block, we can even then wait for this pattern as a confirmation to get still into the trade and be able to take a long position. But now we have the confirmation that we rejected the higher time frame order block. We're showing intent, pushing towards the upside, breaking structure towards the upside. If we now get a pattern like this, our chances and our probability are much higher for us to take the trade and win the trade.
Absolutely, yes. But then again, this will come from your back testing, guys, all right? Because you're going to spot sometimes, again, after such a reaction, the market will not come to the extreme point. It's going to find it in the middle somewhere, right? And you're going to spot all of those formations. So I think we should, guys, I want to ask you, do you know how to draw the OBs right now in this new way? Looking for the engulfing candle, using the control key so that you keep your order blocks really tight and precise. Just let me know. Is it clear? And again, of course, an order block should always break structure. I think I have a little, okay, I have a little details. So let's see. Clear. Very nice. All right, very good. Let me see, because I had a little question. So if it turns after 50% of OB, you cancel. Yes, I cancel looking for it because this OB was already taken out. It was mitigated, we say. Therefore, the market should not come again at it and respect again. Very good question by Dustin. How long would you keep your order if it isn't getting tapped, or how far would you let push it away? For the push away, this is just basically your take profit area, and this depends on what kind of target you wanna go for. All right. So on this occasion, if we took long from down there, I would say from a quality perspective, this is an OB right here, isn't it? Have a look at the last buy before the sell. That is engulfed. So potentially, I'm gonna place my take profit right there. Or you can say it's going to reach for this level right there, because this is, if I drop to the daily, this is your daily lower high, right? And potentially the market is going to get into this range, which it just got. So you're looking to take your trade around these areas right there, right? So again, this depends on your plan and what kind of take profit you want to choose, right? And we're going to speak about this one as well, so no worries. Okay, everybody is clear. Very nice. Oh man, I'm so happy it's clear. All right. Do you start your OB from 4H and then going down or you can start from, I would suggest you start from the 4H, bro. Start from the 4H because the 4H is always going to give you the best OBs, the strongest ones. Not to say even the daily, because if you have an OB on the daily, it's really going to get reacted from, all right? And if you just see this weekly price action, this is a no OB right there. This last sell before a big buy that left empty space in the middle. If we drop it like this, right, again, have a look. 50% was exactly taken out, and right now we can actually expect the bull run. And this is a daily OB. Not to say if we drop to the hourly, you can fight it as well right there, right? Which actually missed by a little bit. If we practice again, final practice, guys, I'm not going to spend much time right there. Last sell is this candle. Is this candle engulfed? No, it's not. Can you take it? Yes, you can, but your OB will be a little bit bigger. Then we have this one that is engulfed, but is it engulfed like strongly? Not really. So what you can actually do on this occasion, you can take both candles or you can just take the bearish candle, right? Because it doesn't make a big difference. But on my chart, I had this candle because the next one is actually an engulfing. It's not really a strong engulfing candle, but it is an engulfing. And as you can see, it missed it by just by a little bit. And this is like it comes to all those little details. But again, it was a long setup right there. You can see again, just before the market flushed, double bottom, boom, right now we're breaking above. And this drawdown, this is potentially creating another OB, maybe even on the daily. Have a look. The last sell before the big buy, but still we cannot confirm this because it hasn't pushed above and it hasn't broken structure. Right.
It's just to add the break of structure. The structure break is quite important.
Yeah, very important.
With OBs.
Yes.
To see a clean break of structure. If you can't just look at every candle that engulfs this previous candle as an OB, do we see a clear break of structure to the left?
Yes. Yeah, very good point. Yeah, very good point. So again, don't just go on your charts right now and mark like every candle that is engulfed. No, you have to have context about it. Like it has to be like a swing point as well. Like again, you have this push to the downside, pull back. This move broke structure right there. So this right here is your OB. Mitigate it. Then this one right here broke structure. So this is OB. But you don't draw them like this in the middle, somewhere right here. Let's say you're thinking, it's gonna get too much time to find like wrong examples right now. But I'm sure that all of you said that is clear. So I hope that is clear. Again, as the vet said, you always want to see a break of structure before drawing the OB. Because if the market is in the middle or it hasn't broken structure and it's overall consolidated, let's say, you don't draw it. Let's say this one. Let's say this one. That is not a bad example. So you say, okay, break of structure, cool. Push up, pushes down, but it doesn't break this low, right? So this move to the downside, although this is an indecision candle, it was broken very strongly. It didn't break anything. So this is not an OB to take a short from, right? And what is happening in this market, it is moving up. What OB should be looking for? This one right here. Why? Because this is when the market actually broke structure. It broke the structure on the left. So you always have to build that context. All right. Enough of an OBs. I hope everything's clear.
Can I just add something?
Yes, of course.
Another great thing just to note the direction is, are we still mitigating previous order blocks?
Very good point. Yes.
In the direction that we're going, that still gives us confirmation or the confidence that we are still bullish. Exactly. In this case, we're still mitigating bullish order blocks. So we are still bullish, moving towards the upside. Only when we start to not mitigate those anymore, this is a good example that you're just going to show now, then only is it more possible that we can see the reversal or the shift in direction on the higher time frame or even on the lower time frame.
Yes, very good point that you added here. Very good. Yes. So you can see GU, even if I use the daily time frame, like if you just really zoom in a little bit, it's a little bit hard, but you can see the last sell before the buy, it broke structure. Where is your OB? It should be this candle, the last sell. But then what we do, we take this one, right? Because this one is engulfed. Drag it forward, respect it. This respect also broke structure. So this right here turns into a new OB. Did it break structure? Yes, it did. Was it engulfed? Yes, it was. Tap into it. Another break of structure. Is this an order block right here? Yes, it is. And we just respected it this week. So you can see how the market is actually moving up and is respecting order block from order block from order block. It's just moving like this in an uptrend. And then if you see on the hourly, those are the same OBs that I just showed you, but taken on the hourly. This one, the last sell before the buy, it wasn't tapped and there is a little bit of empty space. Tap to precision. Here we go. Another one was created, which is actually right. This one should be this one. But again, once you have a move, a pullback. Oh, actually, another tip, bro. Another tip. You want to take the OB that breaks structure. That is also important because you can have like a consolidation like this at the bottom. Then the market pushes up a little bit, slows down a little bit, and then strongly impulses to the upside. So it's much better to take this one that actually breaks structure and where the real momentum kicks in. So as you can see, this is a little sell candle. Is it engulfed? Nope. Here is your buy candle that is engulfed and has empty space right there. Tap. Here we go. All right. Enough on OBs, man. All right. Speaking too much. Let's see, what do we have right there? I think just a little bit of details. Yeah, so here we are. We actually already covered some of those points. You would always look for a structure break after the creation of an OB. This confirms the actual OB, right? You would always have to have a little bit of an imbalance after an OB was printed. So you need to see a strong candle exiting, engulfing the previous candle, which is actually going to create that empty space, which we're going to cover just in a second. That makes the RT much more highly probable, the retest, right, for a successful reaction. The candle that you choose for an OB should be engulfed by the next one. We already covered this one. This really gives precision to where the actual orders were launched. All right, so instead of placing on that big order, we're going to place it a little bit below when actually the move started, right? Okay, we can speak about all day long. Yes, Divino, I have a little question as well. Guys, if you feel like it's getting a little bit too long, I don't think I have much to speak more. I'm going to try to rush a little bit. Like, are you still fine, guys? Do you need maybe a little break or something? Or are you really into it and I'm continuing? Or it should be like still focus. Joseph, good. Alex is good as well. Me too. I'm into it. Hype. All right. Okay, guys, just checking if you're not getting bored. All right. Good. Okay, let's see now. So yeah, the candle that you choose for an OB should be engulfed by the next one, right? The higher the time frame, the bigger the zone will be. So keep that in mind. You see that I showed you the daily OBs just on GU, but if you find a daily OB, then you can do it on the 4H. You can do it on the 1H as well. So you will always find further OBs as a confluence. An OB is fully mitigated once it's tapped 50% into the zone. We spoke about this as well. If it a very nice detail as well, guys, make sure to keep that in mind. If it touches the order block really slightly, like if it just touches the little line, let's say this is an OB and it just touches the tap of the OB. This is not a complete mitigation, right? So even if it taps, you can expect the market to make another leg into 50% of the OB. So keep that in mind. Write it down in your notes when you're rewatching this. An OB is fully mitigated 50%. And if it just taps, like very slightly taps the top of the OB, you can expect another move to the downside to tap into the 50%, right? Which might have a lower time frame order block sitting there. Again, if I show you, just want to show you everything full of example. Let's say this is an OB. We just missed it by a little bit, but we want to see a 50% tap right there. What if I drop to the hourly time frame? Let's see. Have a look. Here we have the last sell before the big buy, right? This was actually engulfed. So we have an order block right there on the hourly. Let's say I drop to the 15 minutes. Let me just do this. Let's say I drop to the 15 minutes. What do we have? The market making a down move. Big engulfing candle right here. Where is the OB? Right here. Was it engulfed? Yes, it is. Does it have empty space? A little bit, but it has. So have a look from a 4-hourly OB. We went all the way to the 15 minutes. Not to say if I go to the 5 and the 3, you're going to see even OBs down there. So what we can expect is the market to come into these areas right there, which is more or less the middle of the OB. And once you have this confluence, it's always really good. So make sure to take note of this one, right? When the market taps just very slightly the OB, like this line, and reacts, let me just illustrate it, like this, you can always expect another move down, which is going to come into those OBs that I just illustrated right there, the hourly and the 15-minute, and then it's potentially going to react, right?
And that is why the aggressive entry is not the favorable one. So because it can tap and you can enter, but there's maybe an order block below it.
Exactly.
if it's on the lower time frame, that it still wants to go and mitigate. That's why the confirmation is so much stronger, to wait for the confirmation, wait for the shift in structure, and then to take the trade. Just wanted to add that.
No, very good point. Yes. And let's see. Yeah, again, order blocks are not perfect. So if you're trying to force them too much, just give up. Try to find a time frame that looks good and leave it there. Don't try too hard, because if you see an order block, it should be clear. It should be exited out of momentum. It should be a clear indecision candle, let's say, and just it should look good. If you try to force something like this right there and all of that noise, it won't make too much sense. So don't go for it. And yeah, of course, order blocks are not perfect. Sometimes the market will tap it and go. As I said, the market can sometimes just touch the top of the OB and just reverse and not return. Sometimes it can go far too deep and even break or close below. So sometimes it might even close below the line. It's still fine, right? But still react. So it's always important to wait for confirmation, as David just pointed out. It's always good to wait a little bit for the structural shift in the lower time frames and then to execute your trade, right? And then, yeah, a series of mitigation of OBs on the lower time frame indicate that the market is changing structure. Those are great confirmation for an entry, which we're going to go in depth in the other bootcamp. Imbalance, right? Let's have a look at imbalance. I think this is something new as well, so let's give it a go. What is imbalance in price? Well, we have it in Investopedia, which defines it as a situation which results from an excess of buy or sell orders from a specific security on a trading exchange, making it impossible to match the orders of buyers or sellers. Keep in note this, making it impossible to match the orders of buyers and sellers. That means that there is not enough liquidity, and this is why we have that big move, that imbalance, right? Because there is not enough liquidity in order to be at both sides of the market. So if the market is pretty liquid, you're going to have a consolidation, and you will not be able to make money if there are not speculators to move the price up and down. Because if there is always somebody to be willing to sell or buy, the market is just going to move sideways. But sometimes people no longer want to buy or no longer want to sell, and then the market is going to move. And this creates the imbalance of price, all right? Usually imbalance will be created after the creation of an OB. Really powerful stuff. Imbalance occurs when the institutions are placing a large size of orders and price moves really rapidly, creating like a big move to the upside, right? Imbalance happens on every time frame, from the 3 months to the 30 seconds, every time frame. And I keep repeating, all of those concepts are like repeating on every time frame. So make sure that you are completely aware how that works. The market will always seek to fill those empty spaces and to rebalance price, right? Because if you have a huge move to the upside, the market would like to drop down just to fill that empty space. Like imagine you have like, yeah, how to explain this one? Imagine you have a canvas, like a blank canvas like this, and then we have price action. And then you have this move to the upside. All of that empty space right there will get filled, because the canvas has to be filled, all the canvas. So you're going to have that pullback right there. Then you have another move. Then that leaves another empty space right there. That empty space is going to get filled again. And then this continues until we actually have a reversal. So that empty space will always get filled. Think of the market as a canvas. It cannot just go outside of the canvas. It is always going to be printed inside of it and fill all empty spaces. You can see that big move to the upside. Once you have this, you have all of that empty space right there that has to get filled, that has to be rebalanced. And again, if you remove, the market came all the way down to the bottom to fill that empty space. And here we go again, right? Here you have again, push all that empty space, it will get filled. But enough of this. I'm getting too carried away, right? The market will always seek to fill those empty spaces, right? And to rebalance the price. Let me put the presentation. Also, something pretty important, imbalance is a form of liquidity. So liquidity, remember what it is? That is what the banks need in order to plot their orders. The empty space, the imbalance, is also this. It's also a form of liquidity. So if you see imbalance, this is when the market is going to be driven into to potentially for the institutions to launch their orders, right? The banks will still seek those areas. And a really good example is having an OB with imbalance just above it and equal lows, right? The market will be seeking to fill that imbalance and tap into the OB while still taking the liquidity from the equal lows. So basically, I actually have the setup. So this is it. So imagine you have this OB, you have the equal lows, and there is imbalance just right there. The market taps and goes, but this a little bit later. So here is actually a little drawing on imbalance. Come on, man, how to imagine it. So this is balanced price action. So you have the push to the downside, you have a little candle, then this one. Yeah, let me see, somebody mute it. Does anybody have a question? Okay, that's Federico. Okay, let me mute. The recording, yes, the recordings will be posted. Yep. So if you guys are tired or something, make sure to, yeah, everything will be posted. So this is imbalance. Again, imbalance occurs where there is a difference. Usually you take it in a sample of 3 candles and you look at the wicks. So you can see right here, this big candle, and then this empty, oops. Oh, come on, man. This empty space right here wasn't fulfilled. While with this wick right there, if you translate it right here on the right, it got filled, right? And the same for an uptrend. We have a push, little candle, the next market opens, the next candle opens, fills that balance right here, balances the price, fills the empty space, and then it goes. But right here, we have this big candle, and then the next one straight goes up, leaving empty space right here, which is basically your imbalance. And if I just go, you can see this everywhere. Let's drop to the monthly time frame just to experiment, all right? So let's just zoom in a little bit. Have a look. So right here, the market created an OB, the last buy before the big sell, all right? So do we take the bullish candle? No, because it's not engulfed. Do we take the next candle? Yes, we do. Does it leave in balance? Yes, it did. So here is your monthly order block on GU. Very interesting, right? Does it have imbalance? You take it in a sample of 3 candles. 1, 2, 3. This candle was way too bullish, and there is that empty space right there between this wick and this wick. So this empty space has to get filled. What did price do very recently? Fill that empty space. If I do it again, let's do this. This is monthly time frame, guys. Keep that in mind. We have this strong push to the upside right here, this candle. The next candle prints, but still it hasn't filled this wick, all right? So if I just drop a little arrow like that, have a look. I saw that actually there was a, come on, man, what are you doing? Why do you play like this? Yeah, have a look. We tapped, we filled the empty space, the imbalance, and here we go. And this is done on every time frame. Empty space right there. 1, 2, 3 candles. This big candle created empty space from this wick to this one. You can actually, I used to mark it like this from wick to wick, and you can actually translate this on the left and type as an imbalance. You have this indicator as well, which is going to show everything where you have empty space. So yeah, is this concept clear, guys? Yes, fair value gap. Yeah, this is another name for it. We are going to be using imbalance because it's pretty much simpler, and fair value gap confuses people. So imbalance, right? Okay, I see that is clear. It's just the difference between 3 candles. Here we have it again. Between those, we have empty space, and this in the future is going to get filled. If you drop to the 1 minute, have a look. Let's say that this is little empty space right there. Did it get filled? Almost. It got filled later. You can find them everywhere. Little empty space right there, got filled, then we move. Empty space right there, filled, and we move, right? Yeah, I can see the indicators, yes. So yeah, fair value gap, nephew Sam. Does it work like OB? No, it doesn't work like OB. It's actually something that you can use for confirmation of an OB. Have a look at this example. This is an OB, and then you have this big engulfing candle. Does it have empty space? Yes, it does. So basically, all of that thing right there will be filled at some period of time, right? Is it more important on a certain time frame? No. Well, Jack, I keep saying that the higher the time frame, the bigger the outcome, and the stronger the reaction, and the stronger the OB and the imbalance. Yes. So if you have it on the monthly, it's going to be big. If you have it on the weekly, it's going to be great. If you have it on the daily, that's perfectly fine. I personally like seeing it on the hourly, on the hourly, and even I look on it on the 15-minute. Because when I look for an entry, if the market creates this OB right there, have a look for this entry right there that I didn't take because I didn't want to trade it aggressively. So have a look. The market tapped into an OB on the left, created that push to the downside. Does it have empty space? Have a look. It has. Between this candle, this and this, there is that empty space that hasn't get filled. And as you can see, the next candle, they're pretty balanced. Everything is filled right there. And then we have to fill that empty space. And if I trigger the indicator, it actually shows it, right? I would not advise to use this indicator too often. Just learn to spot it by eye because it will really make your chart really noisy. It's great when you see it on your entry time frame. Yes. Imbalance is a confluence. Check if there is an OB. Exactly. SI, yes, exactly. It is a confluence. I saw Prince and Walter as well testing just to trade imbalance, which is fine. And basically the rule is that 50% of that empty space will get fulfilled. So you can actually take a trade from right here. Stop loss has to be a little bit larger, but we're not looking to trade this so far. Maybe Prince and Walter can give us a little bit of a recap later how that works for them. So yes, very good point, Asai. Yes, it's a confluence that really makes your order block a more high probability one. So what the imbalance tells you is that it's going to be filled. Yes, exactly. Because if you have imbalance, then it has to be balanced. This is how the market works, right? So have a look at that empty space right there between this wick, this candle, and this. There is this wick came close to that one, but it didn't tap. But then if we have a look at this wick, actually, it almost balanced. So it is a little bit tricky at first, but I promise with all the data analysis, with all the stuff, we're going to point that out very often. So you're going to really understand how that works, right? An empty space is another indication of a strong OB, exactly. And in combination with OB, you know where to enter a trade. Yes, but how to enter trades, we're going to go into the next bootcamp, right? The entry patterns. And currently taking all of that stuff, all of that concepts, we're going to apply them later, right? So later, there are not going to be much explanations because you should already know how those look like. So if you have questions right now, make sure to ask them. But I think it's pretty straightforward. How do we find those imbalances? All right, a little bit more. Liquidity, I think that is pretty easy because I already spoke a lot about it. So basically, liquidity is the ability of a currency pair to be traded, bought or sold on demand. Basically, if a market is liquid, there are constantly buyers or sellers willing to take your position. So a question for you guys I want you to answer in the chat. Is real estate a liquid market, the real estate markets? Is it liquid? If it is, why? If it's not, why not? I'm waiting for your responses. You can unmute the mic as well. Come on.
Yes, because there's other people that want to buy it.
Okay, good. So everyone says it is. Oh, okay. Not always. Okay, Divino, I like this. Okay, it depends. Good. You're getting in the right direction. Yes. Yeah. Okay, so I'm going to say, let me see. Yes, but it takes time to liquidate. Exactly. On the situation. Sometimes there is supply, but no demand. Exactly, Divino. Yes. Yeah. So if there is lots of supply, but no demand, then it means that it's illiquid. It's not liquid. So for the guys that are looking to sell their property, there will not always be a buyer on the other side, right? Selling your house, it's much harder than selling you $1, right? So yeah, in Paris is very liquid, yes. But I just a little question because yes, real estate is not considered to be a liquid market. It is very hard to buy a property and then to sell it later. It's taking a lot of time. There will not always be somebody to buy it, right? Well, with currencies, you just open MT4, you click buy, and you're done on the second. Stocks are also liquid, but they're more illiquid than Forex, and Forex is actually the most liquid market. There will always be somebody to take the opposite side of your trade, all right? So think of that. The concept of liquidity is crucial when it comes to manipulation trading. You really have to understand how that works. There are a few types of liquidity. You have the equal highs and equal lows, basically the double tops and double bottoms. It could be triple, quadruple, 5 bottoms or whatever, which actually will turn into a consolidation if they're more than 3, right? You have also trend line liquidity, which is something that you also have to know because if retail traders are trading trend lines, this is why since 1.0 module, I told you to remove trend lines, right? We don't use them because you can draw a trend line in numerous ways. And basically, if retail traders are looking for a trend line, what the banks are going to do? They're going to fake above that trend line. Let me see. How big does your account have to be before you can't feasibly day trade? Oh, I have no idea, Elliot. Yeah, I don't know. Like imagine you buy 1 million lots. So that is, if you multiply it by because one contract, one lot is 100,000. And if you multiply 100,000 by 1 million, then that's a lot of money. That's the capital that you need, right? So Oh, well, I was looking at penthouses, so they always want to buy such. Okay. So since not enough liquidity to trade like we do. Yeah. Well, I am not sure yet. I don't know how much money they trade, but it's possibly billions, because during a day you have $6.4 trillion exchanged in the forex markets. 6.4 trillion, right? So that is a lot. That is a lot. So imagine how much money they are putting in and out of the market each day. So yeah, yeah. All right. So let's get, good question though. Good question. I hope some of us can reach that level that we have to look for liquidity before taking a trade. Yeah. Yeah. Can't wait to become a billionaire and start stop hunting. Great. But first you have to learn how to do that. So let's carry on, right? The institutions are using those points in order to get into a pool of liquidity, right? Where the stop losses are, so that they can get enough orders, counter orders to theirs. That this refers back to the OB explanations. Why? Well, stop losses, limit orders, stop orders of their traders, of other traders, sorry. So above every high and below every low, there will be orders, all right? So if I just take the tool, if you have a push, a pullback. Above this high, there will be stop losses. Above this high, there will be buy stops. Above this high, there will be something else. Right here, new orders. So above every high and low, there is liquidity. All right. But the more highs and the more lows, the more liquidity there is. That's why we look for equal highs and equal lows. Right. From now on, you have to shift your point of view. This is something pretty nice that you have to do. If you see a double top, mark it as liquidity. We're not going to be looking to trade at the double top. We're going to be looking for that double top to be broken, for the liquidity to be taken above it, right? If you see a trend line and a series of lower highs, mark it as liquidity. And right now we have a great example, just while I'm on it, on EU. Let me see. Yeah, was it EU? I'm not sure. Let me see. I marked it somewhere. Yeah, but even if you have a look at it, guys, let me drop the hourly. Have a look at all of those series right there of lower lows. What will retail traders do? Something like this. Guess what they did right there? Oh man, so many bad stop losses right here. Above this high, there are stop losses. Above this high, stop losses. Stop losses, stop losses, stop losses, stop losses everywhere. So the market will go from one liquidity point to another. This is how it moves, right? There was another trade that oh, here it is, GU. Have a look at this. Higher low, higher low, higher low, higher low. They're more or less kind of equal and building up. So what the market is going to do, it's going to fake below all of those lows in order to gather liquidity and then to potentially go. So this is your trend line liquidity, right? I see a lot of questions popping up. So let me Fanatics, let's start moving to market with 1 million loss. All right, cheers. It's can't wait to become a billionaire. So what does SSL? Yeah, well, Johnny, this is just dollars. This is just the fun side. Yeah, it's dollars exactly. So what I do is just like this. You can type something else. You can type liquidity. You can do it however you want. Just make it look good. I have it as red so that it kind of like picks my attention, so that I know that I'm going to be looking for fake above or below the red line, right? So let's see where I was. Yeah, from now on, I told you we have to shift our perspective a little bit. Why does the market gather liquidity? It's basically a recharge mechanism. So I'm going to give you an example. I'm going on a trip or running a marathon. So Bastien can actually confirm this with me. So imagine that you're going on a trip or you're going to run somewhere. You're not just going to go from point A to point B like this. You're going to stop along the way for toilet break. You're going to stop to have some food. You're going to go again. Oh, the car ran out of steam. You're going to stop again, right? To the petrol station. You're going to come. Oh, the baby's going to cry or it's hungry. You're going to stop again at the station to take something else. And then you're going to reach your point, right? So it's a recharge mechanism. It has to pull back. And this is why we have the pullback, guys, because it has to gather liquidity, right? So let me see the chat. Yes, exactly. Yes. Ilya, so if Asian station trading, so can we draw a trend line? Yes, exactly. Yes. Taking the baby out into the... Yeah, Bastian, can you confirm this to me? When you run the marathon for 100 kilometers, do you just run, you start running and then you finish right there? You're probably going to stop at quite a few points to gather some steam, to eat something, to recharge a little bit, right?
Depending on how fit you are, probably.
What is it, bro?
Depending on how fit you are, can
Oh,
you
wow.
run the entire race?
I don't know. He's running 100 kilometers, so I don't think he can take it in one go.
Oh, 100 kilometers.
Yes, it's an ultra marathon. Yeah, you see, yes, always stop to eat and change myself, etc. So the market will always do this as well. It has to stop, it has to pull back, and then it's go again. Recharge, exactly. So, okay, enough of this. So I hope this example was actually pretty fun so that you understand why the market gathers liquidity and why do we have the pullbacks. And also the market will also generate or engineer liquidity points. What do I, just to take them out later, all right? So what I told you on EU, what the market is gonna do just before reversing, it's gonna do this. And what is this? This is engineering of a consolidation of liquidity. So here the market is pretty balanced. Everyone is willing to take the other side of the trade. Then we have the institution stepping in. Everybody's selling right there. Everybody's selling with sell stops. People having their stop loss that already bought are stopped out. People are selling, break and retest traders are entering right there. So this is a big fight right there. And then we go. So basically you often see just before the market taps into an OB, you're going to see liquidity being engineered. That's how we call it. And then the little concept of liquidity grabs. This is basically the grab that takes you into the trade or that taps into the OB, right? A liquidity grab is basically a stop hunt. This is any break of high, low, equal low, consolidation, or any liquidity point. So basically the liquidity grab right there is this move. So you can identify this as a liquidity grab, or you can actually take out those equal lows. And I actually have it right there as liquidity grab, like an X. That means that liquidity has been taken and we can go again, right? I'd have some retracement during my marathon. Exactly. You need to have them. And after a liquidity grab, you should see immediate response. This is pretty important. You're not going to see the market consolidate too much. It's just going to go, right? Because the market is not going to slow down around those areas there. And it's best to monitor price on 5-3 minutes after the liquidity grab, right? So after we have that spike, you can drop to the lower time frames, because on the lower time frames, you're going to have the same theory, right? So after the liquidity grab, if I drop to the 1 minute right there, see how much price action we have right there during that grab. And we actually have another one. Have a look, push, little bit of accumulation, another break to the downside, another consolidation right there, another break to the downside, right? And then we actually break structure to the upside. But again, I don't advise doing this, going to the 1 minute to trade those things. It's much better to stay a little bit on the 5, on the 3 minute, and waiting for the structure break, and then potentially taking a trade either from here, or maybe even from here, which can be on order block as well. Let's see if it reacted. Have a look. Why is this an OB? It broke structure. Here's your break. Here is your break right there. OB was created, the last sell before the buy. Do we take the sell? No, because it's not engulfed. Do we take this candle? Does this candle leave empty space, guys? I think it does. Have a look. Boom. Empty space right there. OB, tap, 50%. Here we go. And this is basically, well, I'm running out of voice already, man. Very nice. A liquidity grab will always occur in London trading window. So we're going to have that liquidity push, liquidity grab above or below the Asian session. And basically, I have just, let me see, standard, a few examples right there. So you can see, again, this is your Asian session liquidity. This is your liquidity grab, which creates an order block. Remember the example of the order block. In order to buy 1 million lots, they have to sell 1,200,000 in order to push the market down. Then we have a structure break, which confirms this OB. And then what the market is going to do, it's going to create trend lines. It's going to create lows. It's going to create highs. It's going to create, again, another consolidation just before tapping into this OB. And then we're going to have another liquidity grab, and then we're going to go. And all the people that were selling right there, here, they're going to get taken out, which will serve as further fuel for the market to push up, right? So this is that is the little concept there that we have. And then this is just an example of trendline liquidity. When you see the market creating lots of high highs, lots of high lows, then the market all of a sudden is going to spike strongly below to tap into an OB on the left potentially, and then it's going to react very strongly. So this is liquidity. And we are already getting into the next day. So we're going to wrap it up for now, guys. Now it's questions time. Anything that is unclear. We have been, I think, for 2 hours already or something. Very nice. So let's see if we have any questions or something to go into further details. Let me check the chat. You can unmute yourself, guys. We can have a little chat. I've been just listening to myself for 2 hours, so I want to hear some voices.
Got a question for David.
Yeah, David, yeah.
On his squares, I checked on his daily analysis. He's got the LG, SB, and SBT. I just want to ask, what is that?
So each of us, for me, the LG is just liquidity grab. The SB is just the structure break. Yes, that's just
and
how
the SBT.
So for me, I want my structure break to either stand on top of the line or below the line. So that's just for me to know when it's in a downtrend. If you quickly draw a line, yes, Ilya, and then go to text.
Yeah, that.
Just go to text, like edit it.
Oh. Yeah.
Just write SB. And then say, just like at the bottom and left.
Yeah, so then you can do, on the bottom
and left. So now if you, in downtrend, it just looks visually nice if it's on the downside.
It breaks to the downside.
And when we're towards the upside, then I just put it to the top. Otherwise, there's sometimes candles going over it. Or
Bro, shall we make a little breakdown on how for everyone to set the tools like at the same exactly the same way?
I had that request as well.
Good.
On TradingView, so I will do that.
Good. Okay, good. So guys, just be patient. We're gonna do everything. So all of us will have the same thing. So we're actually be like a real nice team. So we're all gonna have the same drawings, the same breaks, because you can see I have them as well. Like I'm using the arrow, then I have here break of structure to the upside, break of structure to the downside, the daily open, imbalance, just a simple level, liquidity grab, liquidity above, below. And the difference is where the actual text appears. I have it on top if it's liquidity above. If it's below, I'll have it on the bottom. Mitigated also, I use this one when an OB is being mitigated. So for example, this one right there, I'm gonna do it like that. So that I know that the market already tapped into it, and then we're going.
Yeah, I was trying to do the exact same as your guys, so I can have them all the same like that. I was just not too sure how you got that tick on there.
We're gonna make everything.
Yes, we'll make a nice video for it.
Good.
Okay, thank you.
It would be nice if everyone used the same thing. Yeah, exactly. If everyone used the same thing, then nobody will be confused on what is on the other person's chart. So yes, we're definitely gonna do this, guys. No worries.
With regards to wick zones, Javier, personally not that much anymore. But as I've said before, to get an idea of where retail traders think price is going. So wick zones are a nice visual presentation of what retail traders think as support and resistance. Seeing that, how can we use that to our advantage and anticipate where price could potentially be manipulated?
Mm-hmm.
Like in my AU trade, if price is, like I said, the one that I missed this week, if price goes into my direction and it breaks, retests normal support and resistance, weak zones, it's another confirmation to hold longer. Price is going in my direction. So that's just how I personally see it.
Mm-hmm. Mm-hmm.
Yeah. So not in detail as much anymore. No.
Yeah.
Primarily the order blocks.
Yeah, I like wick zones, but I think sometimes you can really draw them a lot. For example, like you can see them almost everywhere. Like simple support becomes resistance. Like you can draw this, for example, then you can draw this, then you can draw something else. And there will always be like support and resistance. And as you can see, it always fakes below, fakes above. So it's much better to be really precise, to hone in on the OBs. And then just as the vet said, if this is a wick zone, support and resistance, it's going to get faked. And if you have an OB below, then this can serve you as confidence as well.
Ilya, one question. Alexandro, I think, asks a second time if we should, as target point, take a fib extension or an order block.
Okay. Well, fib extensions are maybe for 2.0 and 2.1. So again, if you have an OB entry, then you don't have the actual extension because you don't have that correction. right? And imagine if you enter in the 5 minute right there. So this is your push, this is your pullback. So your extension is this one right here. So you're not gonna take profits right there, right? On the 5 minute. So again, it depends. Again, we're gonna go in detail onto the next bootcamp about that, where to take profits and how to frame the setups. But usually, yes, you're gonna go for an OB. You're gonna go for liquidity as well. So if you're taking a trade and you have like really nice, for example, this consolidation, you can target above, you can target the OB. But yes, yeah, just to be very straightforward to your question, no. With manipulation, we don't use the extension. If you're not basing the trade, let's say on a higher time frame OB, yeah, but how to give you an example? So let's say you have an OB right there, and again, if this is your pullback, then you can measure the fib again like this, and then you can say, okay, we can reach for the 27, right? But then if you get on the OB right there, you're gonna have a much tighter stop loss, and then you can judge, for example, you can take profit at the lows right there. But yeah, I'm gonna say stick to the strategies if you have a 2.0, because it's really systematic. Push, pullback, then you measure the pullback. Here's your extension, go for it. That's it. Is the New York the opening time of the daily candle? No, Fitki. This is, I explained this a little bit earlier, the difference between that and why this is not the daily open. So you can see the daily range is being filled from 5 a.m. GMT all the way to 8 p.m. GMT. And during the other times, you're going to see consolidation, right? So yeah, this is why we take the New York price, because this is when like the midnight in New York, and this is when the daily range is being filled. So it's not the daily open, but it's 5 hours after the daily open. So make sure that you don't confuse this. What is the setup parameters for the 50% VIP? Zubair, I shared this one in the beginning. But let me just show you. I have it like this. And it's just a 0, it's just a 1 and a 50. And then the colors, you choose them by your choice, right? Sorry, in French, this is majuscule. Where do you write the big letter? Okay. Shift will lock the lines horizontal. Oh yeah, exactly. So if you want to keep your lines horizontal, you hold shift. You can see it draws a perfect line. While you draw it, you hold shift, and it gives you a pretty nice like straight arrow. So that is a very good tip as well. Good for pointing that out. Ilya, are you still using the 2.0 strategy? I just implement. Yeah, I'm not really looking too much, because you know December and January are not good months for continuation, but we've been smashing it with manipulation because the timeframes are much lower, and you can actually use those institutional concepts to grab like just like a little portion of the market per day, but it's great. 2.0s are starting to play just right now, February, because the market is starting to get trending, right? But personally, I am focused mostly on manipulation right now, because it provides a great R&R. It doesn't force you to stay on the charts all day, to wait for that pullback, to wait for the crosses, to wait for the ABC, to wait for that, to wait for the break, for the retest. You're just there. You're just there, take the trade, or you're not there, right? Don't get me wrong. Manipulation setups still take a lot of time to play out, but I feel it's a little bit less than 2.0. But of course, I'm always like looking in terms of 2.0. Where is the structure, right? But nowadays, I'm like, let's say this is a 2.0. I'm not going to take it because I see liquidity above right there, and I see an OB above. Then I have a push, I have a pullback, right? Is this a 2.0? This is a beautiful 2.0. And it worked out. But did I take it? No, I didn't. Because again, I waited for a little push to the upside. But then again, you can see we actually had another setup. OB, push, retest. There is another setup right there to take. So again, it is all about yourself. If you really want to focus on manipulation, or if you just want to look again on the side for 2.0, I would personally not recommend to have one chart like this for manipulation, then another chart like that, and monitoring them at the same time, because you're going to get confused. Let's say you look for a short on you right now, but then manipulation tells you something else. And again, as you said, use the premium and demand zone to potentially frame a 2.0 setup as well. But let's see how it's going to go. Let's see how the market is going to go. I am monitoring. If I see something, I'm sometimes taking a trade. But like I've currently become super patient, super conservative. And even if I miss the 2.0s, I'm always going to wait for a setup, a manipulation setup, because it's probably going to give me above like 6, 7, maybe even 10 R. and I think it's worth the wait. So I hope that answers the question, bro.
Brother, can you quickly just show me how you form the fib block for take profit? So from the reverse and then the standard fib.
Do you mean the stats, or how do I do it?
How you do that take profit block in between the 2.7s of both fibs.
Okay. Well, let's say that we have that push and a pullback, potential lower high right there. We drop to the hourly time frame. We have our rejections right here, right? So if I even, yeah, it's fine. So actually, this is your whole pullback right there. So if I drop to the 15-minute, this is all of your correction, right? So what you're gonna do is you have to take it like in the opposite manner. So you're not gonna draw it from the bottom to the high in order to look for the retracement, but you're gonna catch it from the top to the bottom, right? And then you have the extensions, 27 and 62. So what I explained in the course is that you can take the whole zone and you can look for the 50%. Or what you can also do is you can look for the normal fib, which is from here to here, right? So this is your normal retracement again. And this creates big pockets. So as you can see right there, you have a pocket of 27%. And then you have a pocket of 62%. And then within this, if we drop lower, you have all of that TP area. But bro, I would just say, just exit on the 27 extension, right? Because it's the highest probability fib. And you see, if it taps, it's always going to react from it. But is it clear how it works? I think it's explained in the course, isn't it?
Yeah, it is, yeah.
Okay, so yeah, but yeah, this one works with 2.1 very nicely, but 2.0 as well. Once you have a deeper pullback, you have a nicer correction. So yeah. Okay, Dustin is done. Fitki, Johnny is going as well. So we have people leaving already. So I think we should wrap it up. And we're going to go much in depth into the next one as well and into the webinars as well. So keep your questions, guys. Kid is up from his nap. Gotta go. Okay, lovely. If you enter in the 5-minute time frame, at which higher time frame would you take your profits? Well, again, it depends on what makes sense, right? So if there is an hourly OB above, you take it there. If you believe that the market is going to reach a full hourly OB, you're going to take it there. But again, we're going to go into details for this later, right? So I think we should wrap it up for now. It's been up 2 hours. Thanks, guys. Bootcamp to be in the new week and next Sunday. We're going to inform you guys about this one. We're going to inform you. Cheers, Leanne Devet. Extremely educational. Have a nice evening, brothers. Really nice. Looking forward. Great. Really good bootcamp. I'm really glad that you liked it, guys. Really hope it was valuable and you got a lot from it. Mind-opening. Nice. Thank you, guys. Clement, what did you ask, bro? Okay. Come on, let me hear your voice. Great content. Really nice. All right.
I think Clemence asked something about, where was it?
About fractality. What would be your bias on CAD JPY daily time frame? Some would say bearish, some bullish. Okay, so you like to break CAD JPY?
Yeah, no, so sorry, just not a full breakdown, but just to be, because it's confusing on the CAD yen, because if you look from March 2020, it's kind of bullish, but the fractality concept would say that the CAD yen daily time frame would be bearish.
Why?
Because if you zoom out, you see a break of structure, and all what happened between the swing high and swing low is complex correction. So it should be for our time frame.
Isn't it basically on the weekly we have bearishness, and on the daily we have the bullish trend towards the upside, towards that pullback? So you can take buys all the way up into the weekly order block, and when we see now the rejection and the turnaround, price slowing down and giving us indication that it wants to go short, then we will take shorts on the daily, 4 hour, 1 hour. So you want to see more or less 2 or 3 time frames aligned for you to take that trade in that opposite direction.
Yeah. So yeah, again, you can see you can frame it for the weekly as well. Again, a little practice, final practice. You have the last buy before a big sell. Like this is a really big sell. Does it have empty space? Yes, it does. Have a look at this candle and this candle. There is the empty space, right? And then you have a break of structure, which confirms this order block, right? In between all of that area, you can be taking longs until that OB is tapped. And if you drop to the daily time frame, the market shifted since it broke this structure to the upside. And since then, you have this long, a creation of a new OB right there. Another long right here, tap for a second time. Again, sometimes this could happen. As I told you, you see the market does not create a higher high. That means that there is not enough liquidity. And then we drop below again, push up again. Another OB that actually broke structure was created right here. So you would ask, why don't you take this one, but you take this one? Little detail. I told you to take the OB that breaks structure. And this is the one that breaks structure. Retest, we go again. Another one was created right here. Retest, we go up again. And right now it's rather consolidating. But if I zoom in, you see that we just broke structure to the upside. Therefore, where my OB will be, well, yeah, it should be this one. Then it should be that one as well. But again, if it doesn't make sense on the daily, I'm going to drop to the hourly. And yes, so this is a pretty clear one. And then we have in the middle this one that was already mitigated actually with this wick. So yeah, currently on CAD JPY, I would be bullish. But again, keep in mind that we're getting into this weekly area that can give us some sells, right?
Yeah, for sure.
Good. All right. No problem, bro. It's great to see you back. All right, let's wrap it up then. Thank you so much, guys, for staying. It was a long one. We're gonna have another one probably in the middle of the week or next week. And I wish you an amazing evening and talk to you in the chats. Bye for now.
Bye.
Bye, Federico.
Bye.
Arrivederci.
Cheers, guys. Thank you.
Cheers, bro.
Good night.
Bye.